All right. Good afternoon, guys. All right. Good afternoon. Today we're going to talk about swaps, and under swaps, we're going to talk about interest rate swaps. Okay. When you talk about swaps generally, okay, not any finance related, right? What do we mean by a swap? Okay. Okay. That is a finance definition, Vibor. But in general, what does a swap mean? Is my question. Correct, Shreya. So it means an exchange. Okay. So whenever we talk about a swap, right? We are talking about an exchange. Okay, all right. So now, when you talk, so the first thing that we're going to talk about today, and there are many different types of swaps in the market. Okay, many different types. Okay, and what we'll do is we'll talk about one of the most basic ones that we call what we call as interest rate swaps. Okay, all right. So now let's understand what is the definition of a swap. Okay, all right. Now, when we talk about swaps, right, it is an OTC product. So if it's OTC, what do we mean by this? It's traded, it's a code-driven market. Okay, it's an OTC product between two parties where they exchange cash flows based on various underlying assets. Okay, such as equity, fixed income, interest rates, currencies, commodities, and a lot of other things as well. Right. So, for example, you can even have what we call as a dividend swap. You can have a cross currency swap, total return swaps. I mean, there are more than 50 to 100 different swaps available in the market, right? And what we will discuss in class for today and tomorrow, right, is interest rate swaps, equity swaps, FX swaps, and credit default swaps. So we'll talk about four of them. Okay. So it's an OTC product between two counterparties where they exchange cash flows based on an underlying asset. Is this clear with everyone? Okay, cool. Take a minute, write this down, and then we'll move on to the next part.
Sir, am I audible to you?
Yeah, go ahead.
Sir, basically it is a instrument which is created for cash exchange.
Sorry, I didn't understand.
Sir, basically it is an instrument which will be traded and there is a buy and sell is also take place for cash exchange. It is this.
No, no. So no, we'll talk more about it. So when you talk about cash flows, right? So don't worry, we'll discuss it, okay? Because it's not what you think it is. Okay, it's not. Uh, it's a little bit more complex than what you think. So give me some time. We'll cover the entire definition and we'll work out some examples. Okay.
Okay. Okay.
Okay. Everybody done? Okay. Cool. All right. Now, when you talk about a swap contract, right? What that means, a swap contract, right? It basically describes how cash flows are to be calculated. Okay. Now, what do we mean by this is that there's something known as a receivable leg and a payable leg. Okay, and for now, right, just write down the theories, okay, of all that I'm going to give you guys, right, and we'll work out examples, and then you guys will understand what I mean by this. Okay, so a swap contract, okay, describes how cash flows should be calculated. There's a receivable leg and a payable leg, okay? And swaps work on a similar notional value. Now, what do we mean by notional? It means the total value of an asset, okay? A total value of an asset, okay? So, for example, right, let's say if you and I enter into a forward contract, and let's say the forward contract, you know, let's say it's 10,000 shares of company ABC, and let's say the price is $100, right? So what is the notional value of this? What is it? It'll be $1 million, right? $1 million. So this is what we mean. So this $1 million is the notional value, okay, of the forward contract, okay. So in a swap, right, what we're looking at is the notional value, and those notional values will stay fixed. It will not change. Okay. And what will happen is, and that is one type of swap. So the type of swaps that we're going to talk about, right? We're going to assume that the notional value will not change. Okay, notional value will not change. Okay, so it's going to stay fixed throughout the life of the contract. So that is why when we what do I mean by swaps work on similar notional value is that if I am client A, right, and you're client B, and if we enter into a swap contract, right, the value of the swap contract or the notional value has to be the same. So it should be 1 million, and you also should also have 1 million as the notional. Okay, so it works on similar notional value. Okay, and then we'll talk more about this payable lag and receivable lag. Okay, but we'll talk about it in a bit. Okay, so write this down, and then we'll move on to the next. So Shreya, which part do you want me to repeat? Okay. So if I'm client A and you're client B, okay, is that the if we enter into a swap contract, both of us should have the same value. Okay, so it should be, for example, if I have taken a loan for 1 million US dollars, you also have to have a loan for $1 million. Okay, so a notional, so a swap cannot work if I have $1 million and you have $10 million. Okay, so that is why the notional value has to be the same. All right, and then there's something known as a payable and a receivable leg, and that we'll talk about in a bit. Okay. All right. Take a minute and write this down. Okay. Okay, cool. Most of the time. Okay. So now let me clarify a little bit more on the notional value. Okay. So when we talk in a swap contract, the notional value does not exchange hands. Okay. The notional, so if I'm on $1 million loan and you're on $1 million loan, right? That does not exchange. Okay. So that means I do not give you $1 million loan and you give me your $1 million loan. Okay. So the notional value is going to be sitting with each of us. Okay. But it's the cash flow based on the value of the notional, that is what will be exchanged. Okay. So I know it doesn't kind of make sense, but when we work out a couple of examples, right, then you guys will understand this. Okay. So again, in a swap contract, the value does not exchange hands. So that notional value does not exchange hands. Okay. Rather, what it is that it's a cash flow based on the underlying asset and not the value of the notional that will be exchanged. Okay, so basically, we have to calculate the cash flow based on the notional value. Okay, so don't worry, we'll figure it out, and you guys actually know this when we did all the forward contracts, right? And when we did the cash settlement piece, right? That's essentially what we're going to do here. Okay, but don't worry, we'll get to it. Okay, so write this last part down and then we'll get into the first swap, which is called as interest rate swaps. Okay, so any questions up till now? Okay, and guys, like what Sora was mentioning before, right? Whenever you have doubts, right, clarify it. Okay, and I don't want this to be a one-way kind of thing where I just keep talking and you guys just keep writing. Okay, like last week, right? At least I had a lot of fun discussing about random stuff, right? But so whenever you guys have questions, right, stop me and we can talk about it. Okay. All right. So now the first thing that we're going to talk about, or the first swap contract that we're going to talk about, is known as an interest rate swap. Okay? Interest rate swap contract, otherwise known as IRS. Okay. Now, an IRS is an agreement between two parties to exchange one stream of interest payments for another over a set period of time. Swaps are derivative contracts and trade over the counter. Now, like I mentioned before, there's a receiving leg and a payable leg. Okay, now in the case of an interest rate swap contract, right, the counterparty receiving the fixed rate, okay, the counterparty receiving the fixed rate is known as the receiver, and the payable leg is the counterparty paying the fixed rate is known as the payer. Okay, now again, I know a lot of this doesn't make sense, but once we start working out the problems, right, then you guys will understand. Okay, but essentially, when we talk about an interest rate swap, it's an agreement between two parties where they exchange one stream of interest payments over a set period of time. Okay, and there's a receivable leg and a payable leg. Is this clear with everyone? This is the formal definition for interest rate swaps.
So what is one stream of interest payment for another?
Sorry.
So what is one stream of interest payment for
Ah,
another?
So, okay, so coming to that. So, what do we mean by this is when you talk about interest rates, right? What are the different types of interest rates we have? When you talk about interest rates in general, right? What are the different types of interest rates do we have? Okay, prime lending rate. So, this prime lending rate is otherwise known as what? So, correct, MIBOR, LIBOR, etc. Sort of. But what do we? Yeah. So the other sort of you got it. Okay. So when we talk about interest rates, right? Essentially, there are two types. Okay, what we call as a fixed rate and a floating rate. Okay, I think this is clear with everyone, right? So when we talk about an interest rate swap, right? What's happening is that the there's one person or one, let's say, corporation or client or company that have taken in a loan on a fixed rate, and another one has taken a floating rate loan, and what they want to do is they want to exchange their payments. Okay, and that's what we'll talk about today. So give me some time and we'll discuss that. Okay, all right. So when you look at this, right, so types of interest rate swaps. Okay, there's a fixed rate and a floating rate. Okay, let me put this up on the screen now. Okay, all right. So there is a receivable and a payable. Now, when you talk about in types of interest rates, you have a fixed rate and a floating rate. Now, when you talk about a fixed rate, what do we mean by this? Is that the interest rate is fixed through the life of the loan. So largely from a retail perspective, right? Vehicle loans, personal loans, education loans, etc. Right? They are on a fixed rate. Okay. Now, floating rates, and we'll talk more about floating rates in a bit. Okay. During the life of the loan, the interest component or the interest rate will keep changing. Okay. Now, when you talk about the different types of interest rate swaps, right, there are basically two types, what we call as vanilla swap and basis swap. Okay. Now, in a vanilla swap, it is fixed versus floating, and in basis swap, it is floating versus floating. Okay, and we'll talk about both of them. Okay, but as of now, are you guys all clear of what is an interest rate swap? Okay, what is receivable? I know this receivable leg and payable leg is not yet clear, but we'll discuss that when we are talking about some examples. And the different types of interest rates is your fixed rate and floating rate. And the different types of interest rate swap is a vanilla swap and a basis swap. Okay, is this clear with everyone? Okay, cool. Uh, Take a minute and write this down, and then we move on to the next one. And then I'll get a little bit more. What do you call it? I'll talk a little bit more about the interest rates. Let me know when you're done. Sure, sure, no problem. Once all of you done, then we'll move on. No, Vibhor, I didn't get a chance to. I'll try and read it this weekend. I've had like 2 to 3 classes every day last week, so it was quite intense. So I'll get to it mostly this weekend or early next week. I'll get to it. Everybody done? Okay. Now let me ask you guys a question. Okay. Um, Now let's say that you buy a house. Okay, you buy a house, and the bank gives you two choices: a fixed rate and a floating rate. Okay. Now, like I mentioned before, a fixed rate, the interest rate is fixed over the life of the loan. Okay, and a floating rate is that it varies. So the interest rate keeps changing. Okay, which one would you choose? Would you change? And let's say you are taking a home loan for 30 years. Okay, you're taking a home loan for 30 years. So which one would you choose? Fixed rate, floating rate? Okay, floating rate. Okay. So here's the thing.
Sir, am I audible to you?
Yeah, Deepesh, go ahead. Now you're not audible.
Sir,
You're breaking up.
which one I am choosing for my home loan? Hello? Sir, I am audible?
Yeah, yeah, you're breaking up. How about you give me 1 second, Deepesh? Let me finish my explanation and then you can ask your
Okay.
question. Okay, Deepesh, can you hear me? Okay, I think network. All right. So let's look at this, right? So now we have mixed answers here. Okay, and there's
Yes. Yes.
23 of you here, but I got, I think, responses from only like 8 or 10 of you guys. Okay. Now, when you talk about a home loan, right? Now, generally, a lot of these, when you talk about a home loan, right, it's generally taken for 30 years. Okay. Now, in a 30-year period, okay, uh, what happens is that if you stick to a fixed rate, right, you will feel okay, yeah, that's a really good this thing. So I'm going to pay the fixed rate forever, and it might be cheaper than the floating rate. Okay, that is one point of view, which is also correct. Okay, and there's another point of view is that hey, if I'm on a floating rate, right, that means that sometimes I'd have to pay a higher interest, sometimes I might have to pay a lower interest. Okay, but generally, right, okay, being on a floating rate is better than being on a fixed rate. Okay, especially in a 30-year period. Okay, now let's look at this. Let me see if I can draw this. Can you guys see that line? Yes. weird I've got. Right, 1 second. Let me see. Erase all drawings. Let's look at yellow. Okay, okay. So you guys see this. Okay, now let's look at this. So there's like a graph. Okay. So when we talk about a fixed rate, right? So let's say that this is your this is fixed rate. Okay. So imagine it to be a straight line, right? So throughout the entire 30 years, right? So this is your 30 years. This is your interest rate here. Okay. But what happens is when you, okay, so a lot of you said, okay, fixed rate would be the best. Okay. Now it really depends on a lot of factors, but on an average, right? Or generally speaking, it is better to be on a floating rate. Now, why do I say this is that what happens to floating rates? It can go up like this, it can go down, it can go up, it can go down, right? It can keep doing that. Okay. Okay, terrible. Okay, terrible drawing. But getting the idea, right? So the idea is that generally it is cheaper to be on a floating rate. Now, I don't know if you guys know this, but a lot of countries in Europe, okay, a lot of countries in Europe, they are actually gone to negative interest rates. Okay. Now, what do we mean by negative interest rates? Does anybody know? So I'm not talking about the fixed rate as being negative, but the floating rate as being negative. So what do we mean by that? Okay, banks pay to lend money. Okay. Now let's think about it from our perspective. Okay. Uh, Generally the mindset is that if I deposit money in my HDFC account or whatever account, right, what happens is that I earn interest, or the bank pays me a certain amount of interest on a quarterly basis. But when we talk about when the interest rates become negative in the market, right, is when, let's say I deposited 10 lakhs into a bank account and it's negative interest rate. So instead of them paying me interest, they will actually be deducting the amount from my principal. Okay, so every quarter they will actually take money from me. Now, these are in the world of finance, right? These are all very what do you call it? All very intense and all very crazy things that are happening in the past 15 years in finance. Okay, so and what happens is that because the banks are going to take away your money, what ends up happening is that the if you're the investor, if you are the person who's having that money, right, you will obviously not put the money in the bank. So if you don't put it in the bank, what are you going to end up doing? What will you do if you cannot put your money in the bank? What do you guys think? Exactly. Most of us are going to spend that money or you'll invest that money. Okay. And what happens is that because you are going to spend or invest, or let's assume spending, right? Because most of us, actually, believe it or not, right? Most people in the world don't know anything about investments. Okay. When you take the entire world population, it's a very, very small percentage that actually know anything about investments. Okay. So largely people will spend, and what that does in turn is to help kickstart your economy. So that is why Europe, right, has been in negative interest rates for a couple of years now, and even the US, right, they're also headed towards that. They're also headed towards a negative interest rate. I think it will happen soon if it's not happened already. Okay, so are you guys clear about this fixed rate idea and the floating rate idea? Okay, is it clear with everyone? Does it make sense? Yeah. Okay. So take a minute and write this down. Okay. And then we'll move on. And you can ignore. Wait. Let me remove this ugly drawing. But you guys got the idea, right? All right. So write this down, and we'll move on to the next thing. And next thing we'll talk more about the floating rates. Okay, cool. Okay, shall we move on? Okay, so let's talk a little bbit more about floating rates. Okay, now floating rates are also known as benchmark rates. Okay, now what do we mean by the term benchmark? I just want to know the term benchmark. What do you think benchmark means? Yeah, Vibhor, it would. Yeah, the banks will suffer. Yeah, yeah. Okay, it's a reference point or it's a comparison. Now, for example, right, if I tell you that for next week the Viva, the benchmark is 10 out of 10. Okay, so that means that all of you so that's the highest possible that you guys can get. Okay, so that's what we mean by benchmark. Okay, now when we talk about interest rates, right? There are various types of interest rates in the world. Okay, various types, and each country has its own interest rate. Okay, so for example, in India, we call that as MIBOR. Okay, MIBOR. Okay, it's also known as Mumbai Interbank Offer Rate. Okay, now one of the most popular benchmark rates in the world is known as LIBOR. Okay, not Libor. So sometimes students pronounce it as Libor or liver, even liver. I've heard liver. So it's not Libor, liver, or any other derivation of that, but it is LIBOR. Okay, LIBOR. Okay, so that stands for London Interbank Offer Rate. Okay, now this London Interbank Offer Rate, all right, was created by the British Bankers Association, and it was a way of and it was outsourced to Thomson Reuters. Okay, this way back almost what do you call it? 20 years ago and up till even 2012, right? Thomson Reuters was doing the calculation for the LIBOR rate. Okay. Now, what used to happen was that uh, so British Bankers Association created LIBOR. Now let's understand why they created the LIBOR. Okay. Now, if you guys now let's imagine in the UK, right? There are about 16 major banks. Okay, like Barclays, Royal Bank of Scotland. What else? HSBC. Lloyd's, TSB, etc. A lot of big banks in the UK, right? Now, if back then, if you wanted to take a loan, who would you go to? Who would you go to take a loan from? Which bank would you go? Which bank would you go to? So, if there are 16 banks that you have a choice to take a loan from, which bank would you go to? Yeah, I'm talking about Deepesh, not talking about as I'm talking about London. Yeah, Lehman Brothers. Yeah, well, then you don't have to pay at the end of it, right? That's good. Okay. But ideally, what happens, right, is that the one with the lowest interest rate. Okay. Now, when we talk about, so now what happens is, right, for a bank, one of their most profitable businesses, right, is lending. Okay, it is very very profitable. But unfortunately, in India, right, the banks went a little crazy, especially SBI, right, and they just have given out thousands and thousands of crores of loans. I think I remember reading an article where I think the bank SBI, right, as a whole, wrote off 66,000 crores as bad debt. Okay, I don't know if I think it was about a month or 2 months back that they were writing off 66, close to 66,000 crores as a bad debt, and they're not going to recover it. Okay, so that's the dark side of the this thing, right? Of lending is that if they don't recover that money back, it eventually becomes bad debt or non-performing asset, and they'll eventually write it off. Okay, there's nothing much that can be done about it. Okay, but now why the floating rates were created was that now let's say that let's say that if we have 16 biggest banks, and the competition would be so difficult, right, between all the banks, that eventually the bank, to make that transaction happen, right, they might even give the loan interest free. So then what happened is that the banks came to the I mean, since they have an association, they said, you know what, if we are this competitive with each other, none of us will end up making any money. Okay, none of us will make end up making money. So we need to create a benchmark. Okay, so what they did was that they created LIBOR, London Interbank Offer Rate. Okay. Now, initially, for many years, right, it was Thomson Reuters, okay, that did the calculation for LIBOR. Now, how they used to do it was that it was a very simple method back then, okay, was that they used to call the 16 biggest banks on a daily basis, and they would ask them what is the rate which they're going to borrow at, and what is the rate that they're going to lend at. Okay, and this was supposed to be, quote, given in secret. Okay, so quotes. Okay, they were supposed to have given this in secret to Thomson Reuters. Okay, and they did this for many years, and what eventually and based on the 16 banks giving those interest rates, right? Then Thomson Reuters, what they would do a very simple thing. They would take these 16 interest rates, okay, they would remove the top four, they would remove the bottom four, okay, so that leaves you with eight, and then they would average out that eight, okay, and then they would publish LIBOR, okay, on a daily basis. So it was a very straightforward method, okay. But like I mentioned before, right, uh, since it's a very lucrative business and it's a very profitable business for banks, right, and we as humans, right, are very well, for lack of a better term, right, greedy, right? And there's nothing, by the way, there's nothing wrong with being greedy, okay? I'm very greedy as well, right? So it's fine, okay? So if somebody says, "Oh, I'm not greedy," it's fine. That's their point of view. But I'd rather have more money than less money. That's just my point of view, right? I'd rather have more money, or as much money as I can have, than no money at all, right? I think a lot of you would agree with that, right? So think about it this way. Would you feel happy having $1 billion in the account, or would you feel happy for having, let's say, $1,000 in the account? Let's say, okay, let me put it this way. What would you rather have, 10 crores sitting in your bank account, or 1,000 rupees sitting in your bank account? Yeah, I like that before. So yeah, I'd rather cry in my Lamborghini that than cry in, sitting in a, I don't know, some other vehicle, right? Okay, so what eventually ended happening, right, happening was that in 2012, Wall Street Journal, okay, they did an investigative report, and they found out that these 16 banks actually, right, they were misreporting their interest rates, okay, and it was the biggest it was a big slap on the entire financial community, okay. Why? Because LIBOR, right, has been in existence for more than 30 years, and LIBOR is used to price a lot of derivative contracts and all of that, and it ended up creating massive losses in the market, like a couple $1 billion was actually lost because of this. Now, what was the scam was that, um, for example, let's say I am Barclays, and let's say yeah, the LIBOR rigging scam. So let's say Saurabh is Royal Bank of Scotland. So I would call up Saurabh and tell him, see, Saurabh, I have a huge amount of money that I have to lend to my client. So can you increase your interest rate? Now, what happens is that if all 15 of you increased your interest rate even by 0.25, wouldn't the average then be higher? Right, the average would be higher, then I as a bank would make more money, okay. And then it was called as the gentleman's agreement, right. What that meant was that is when you had to give out a huge loan, you would call me and say, okay, Rashid, I'm giving out a huge loan, can you increase your interest rates? And I would say no problem, right? I would say no problem, and that's how they rig the entire this thing. Okay, they rigged the entire market and they mispriced LIBOR. Okay, then eventually what happened was that all the banks were fined heavily for it. And here's the interesting thing, right? What do you call it? Their internal audit team, external audit, regulatory audit, nobody caught it. It was Wall Street Journal who actually broke this. Dipesh, I'll recap this. Wait 1 second. Okay. So they actually broke this news. So at the end of it, with all the 16 banks and hundreds of employees who were actually involved in the scam, right? What ended up happening was that only one person went to jail. Okay, only one person went to jail, unfortunately, and bad luck for that person, right? But there are hundreds of people involved in this, and only one person ended up going to jail. Okay, but the banks were fined heavily for this, and eventually, what happened was that Thomson Reuters lost their what do you call it, right to do this, and it was transferred to a new organization called as ICE. Okay, that stands for Intercontinental Exchange. Okay, now one last bit, and I'll give you the notes for it. Is that now when we talk about, so now let's say all 16 banks, right? Now if everybody's charging the same interest rate, can we make a profit? If everybody charges the same, can we make a profit? Exactly. Yeah. No, we don't make profit, right? So it doesn't make sense. Okay. So what happens is that you had a benchmark rate that was published every day, and the banks now had the freedom to charge above the floating rate. Okay. And that floating rate is what we call as a spread. Okay, and that spread is basically the profit that the bank earns on the loan that they gave out. Okay, so what did was they standardized the interest rate, or that everybody can borrow and lend at, but on top of that, the commission, right, would they would charge slightly above that, and that is the commission that the banks would earn. Okay, is it clear with everyone? Okay, so Deepesh, I'll repeat again, but for the rest of you, is it clear? And connectivity is fine, right, for everybody? I think Deepesh, you're having connectivity issues specifically. So Shreya, commission for the or they're earning profit by giving out that loan. Okay, so for example, right, I've written here, let's say LIBOR USD, okay, 12-month LIBOR. Let's say the LIBOR rate is 2%, okay? So they will charge a spread, okay? Okay, they'll charge a spread which is basically in basis points. That is 30 basis, for example, 30 basis points. Okay, so total it will end up becoming like 2.03 or 2.30. Okay, yeah, 2.30. Okay, so take a minute and write this down. Okay, but anyway, the class recordings will be given to you. So it's difficult to recap the whole thing, but I'll just give you the gist of it. Okay, Dipesh, are you able to listen, or are you not able to listen? But are you able to hear me properly? Hmm. Okay, so let me recap this. Okay, so when we talk about interest rates, you have two types: fixed rate and a floating rate. So one of the biggest or the most popular floating rate that is used in the world, right, is called as LIBOR. It stands for London Interbank Offer Rate. It was created by the British Bankers Association. And what ended up happening was that they had given this process of calculating LIBOR to Thomson Reuters. Okay, and Thomson Reuters, what they used to do is they used to call up all the 16 banks and get the rates at which they're borrowing and lending. Okay, and borrowing and lending, and they would remove the top four and remove the bottom four, and the eight that was left they would average it out, and they would publish the LIBOR rate, and that was the rate at which everybody in the market would borrow or lend. But since everybody had the same rate, they there is a concept called a spread. So that spread is basically the profit that they earn by giving out that loan. Okay, is this clear with everyone? Okay, take a minute, write this down, and then we move on. Yes, correct, Visvajit. Yeah, and that's the spread. Yeah. But TRS Thomson Reuters.
Sir, please explain this. They use Thomson return to help with the calculation of LIBOR. I'm not understanding.
Uh, so see, it's very simple. What Thomson Reuters would do, right? They would call all the see when I say 16 banks, these are the 16 biggest banks in the UK. They would call them and ask them what is the borrowing rate that they are offering and what is the lending rate that they're offering. Now, this borrowing and lending rate depends on the bank deposits, right? So, and obviously each bank has a different amount that is the amount of deposit that they have, right? So each bank would give that rate, and what Thomson Reuters would then do, right, is they would take this 16 rates, okay? So six lending rates one side, borrowing rates one side. Then they would look at which is the ones which is the highest, which is the ones which are the lowest, and they would largely look at the ones in the middle, okay? So then what they used to do is that they'd remove the top four and the bottom four, okay? And the ones in the middle, right? They would average that out and they would publish that as the LIBOR rate. Okay?
Okay, thank you, sir. And sir, this is what the completion or competition or completion. This is what uh, below this.
Mm, competition. Is that wrong spelling?
Okay.
What's gone wrong?
Okay. Okay.
Yeah, competition. No, looks correct. No, competition. Is that correct? Competition. I think it's correct now. Okay. All right. So the last sentence, right? So what I'm saying is that, for example, let's say LIBOR for US dollar, okay, 12 months, okay. Let's say the LIBOR rate is 2%, okay, 2%. So they will charge a spread or a basis points, which is let's say 30 basis points, okay. I thought we had spoken about this. Okay, now let me write this down, okay. So LIBOR, right, publishes the rates for the following currencies. Okay, USD, Euro, GBP, the major JPY, and what's the other one? USD, Euro, GBP, JPY. I think CHF. CHF is also a major currency. The five currencies. Okay, and what they do is that they publish the rates, publish the rates for 1 day, okay, 1 week, 2 weeks, 1 month, 2 months, 3 months, 6 months, and 12 months. Okay, so what that means is that if LIBOR is public, so they have a daily rate, a weekly rate, 2 weeks, 1 month, 2 months, 3 months. Okay, now these rates slightly differ from each time period. Okay, so a 1 day LIBOR rate is different from a 1 week LIBOR rate. Okay, so now they publish it for all these currencies and for these time periods. Okay. Now, when I say a 12-month LIBOR, means that if somebody wants to take a loan for 12 months, okay, for 1 year, what is the rate that you're going to charge? Now, in the market, it is 2%. So all the 16 banks are going to charge 2%. But then, how does the bank earn commission, right? So, or profit by doing this, they charge a spread. Okay, and that spread we generally will call that as a basis points. Okay, so generally in finance, right, we don't use percentages too much, we use basis points. Okay, now how does this work? I thought we have talked about this before, I don't know. Okay, so 1% equals how much basis points, do you guys know? Yeah, it means 100 basis points. Okay, and 0.5 percent equals 50 basis points. Okay, and point let's say 25% equals 25 basis points. Okay, so that's how. So for example, right, if I say LIBOR rate is, I'm giving a hypothetical number, let's say is 1.5 percent. Okay, and what I'm going to do is I'm going to charge 25 basis points as an additional 25 basis points, which what that means is that that 25 basis points is the profit that I'm going to earn by giving out this loan. So the net is going to be 1.75%. Okay, is it clear with everyone? Yeah, cool. All right. Now, well, for your homework, right? So this is more for you guys to get into the habit of understanding what's out there. I want you guys to find out what are the various benchmark rates in the world. Okay, like we've already discussed two of them. So in India, we have what we call as MIBOR. Okay, Mumbai Interbank Offer Rate. Okay, and we discussed about LIBOR as well. Okay, so you guys find out the others as well. Okay, and it'll help you guys understand. Okay, let me know when you're done, and then we'll move on.
Sir, am I audible to you?
Yeah, Deepesh, go ahead.
Sir, please explain this again from the competition between banks is on the spread as opposed to profit.
But what is your doubt, Deepesh? It's a pretty straightforward thing.
Sir, so I'm a little bit confused. That's why
Yeah,
I
okay.
want to
What is so
recap
see, the
this.
thing is, you have so Deepesh, I'll answer your question, but you have to be specific with your question, okay? Because
Sir,
then that'll help you to clear your doubt. What specifically are you confused with?
the example, LIBOR US dollar 20 million or 12 million
No, it's not 12
in
million. It's just 12 month. It's 12-month rate.
oh, so I'm confused in this example and the LIBOR published rate for US dollar and euro, and what is this? I'm confusing these both.
Okay, see, LIBOR, they publish the interest rates for each of these currencies for US dollar, Euro, GBP, JPY, and CHF. Okay, so see, LIBOR is calculated. So when they call up the banks, right, they will ask them for each of these currencies, and the bank will give them the rate for each of these currencies. And you got to understand that LIBOR is used internationally. So even though it says London, right, you got to understand that London, at the end of the day, right, is the biggest financial center in the world. It is bigger than the US. Okay, so lots and lots of transactions happen through London. So that is why they will publish this for the entire market. When I say entire market, the entire world, and that's the currencies that they will publish it for. Okay, and then
Sir, it means
uh,
LIBOR is not only for London. The various countries are following
exactly,
this. So,
exactly.
yeah.
All right,
That's okay.
is it clear now?
So, sir, yeah, this is LIBOR US dollar, 20 months, and then, so what is this?
Then the rate is 2%. So LIBOR, let's say it's 2%. So if you're going to, so everybody in the market is going to charge 2% as the base rate. Okay, and anything above that is what we call as a spread. And the spread is the profit or the commission that the bank is earning by giving out this loan. Okay, is it clear now? Arpit, you don't have my email ID. Okay, okay. That's the email ID. Okay. But quite a few people are missing today, right? Okay. Biswajit, MyBor, right? Let me check on that because I think MyBor is a little bit more complicated. And one more thing, let me add this, okay, is that LIBOR will be decommissioned or it will be basically decommissioned. It will not be used by about 2021 or 2022. They're going to discontinue LIBOR because they realize that it can be easily manipulated. So what they're going to do is they're trying to figure out uh, some other way to give out the rates. Okay, and that is one. And right now, so what I've explained, right, is what Thomson Reuters was doing previously before the scam. Now after the scam, they use a different methodology which is quite complex, okay, which we call as waterfall methodology. So you guys don't need to know it per se, but understand that this what I just spoke about, right, is what happened before the LIBOR rigging scam. And again, I want you guys to read about the LIBOR rigging scam. Okay, it'll help you to understand what they were doing. Okay, all right. Is everybody done writing? Okay, okay, waiting. Okay, sure. Okay, finish up. Everyone done? 1, 2, 3, 4, 5, 6, 7, 8, 9. Okay, 10, 11, 12, 13. Okay, cool. Okay, so at least you got half. Half. Okay. All right. So now let's understand why interest rate swaps. Okay. And we'll work out an example as well. Okay, so that you guys get the idea. Okay. Now, when we talk about interest rate swaps and why they do it, right? The answer is that they want to reduce, both parties want to reduce the borrowing cost. Okay. Now, what do I mean by borrowing cost? Basically, the interest, okay? And both parties are speculating on the floating rate. Okay, both parties are speculating on floating rate. Okay, so let's look at this. Okay, now let me just remove a few things here. Okay, let me just remove the whole thing and start from the beginning. Okay, so why IRS? So I'll when we do the problem, right, you guys will understand. So to reduce the borrowing cost, and both parties are speculating on the floating rates. Okay, now let's look at this. Okay, so we have company A. Okay, everybody can see properly, right? It's not too difficult. It's clear, right? It's not too difficult to read. Okay, cool. Now let's say that we have company ABC, company ABC, okay, and they have taken a loan of USD $1 million. Okay, so let me $1 million from Standard Chartered Bank, okay, and they're paying a LIBOR rate. Okay, they're paying LIBOR, and let's say plus 10 basis points as the spread on this. Okay, so this is the first thing. So I'm going to do this piece by piece. Okay, so let's just first concentrate on company ABC. Okay, so they're taking $1 million loan from Standard Chartered Bank, and they are paying LIBOR plus 10 basis points. Okay, now I'm going to use exaggerated numbers in terms of the interest rate. Okay, so that you guys get an idea. Okay, of how it works. Now let's say in Q1 the LIBOR rate is 4%. Okay, LIBOR rate is 4%. So what will company ABC pay to Standard Chartered Bank? What do you think they're going to pay? First, tell me how much rate they'll pay. Yeah. Okay. Are you guys understanding it? Yeah, it's going to be 4.10. Where's the percentage sign? Okay. Yeah. Okay, 4.10. So we'll come to the calculation. Okay. So what does that mean is in Q1, okay. So what do? You take the $1 million. Now, what is this $1 million again? This is the loan amount, but in a swap contract, this is the notional, okay, into 4.10%. So how much will we get? $41,000. Is this correct with everyone? No, sorry, well, that's terrible English. I'm sorry. It's not correct with everyone. Is it clear with everyone? Okay. Sorry. Sometimes my English, no, it's just terrible. Yeah. Okay. So you all agree that my English is terrible, huh? I'm just joking. Yeah. All right. All right. Now let's look at Q2. Let's say the LIBOR rate has gone to jump to 6%. So should it be 4.1 or 4.01? It should be 4.1, right? Because what did we do here? Hang on, let's scroll up. So if it is, hang on, 0.10, right? Is 10 bips, right? This is fine with everybody, right? So it's and guys, this is again a percentage, right? 0.10%. Is this clear with everyone? Okay. All right. Now, let's say that the LIBOR jumped to 6% in Q2. Okay. So, what will company ABC pay? So, what will be the net that they pay? 6.10%. Correct? Yeah. So now, how much will they pay? So I know you guys can do. Some of you can do the math really quickly, but I'm quite poor in math. Okay, so that's why, and I'm assuming some of you are. I think we had this discussion. So I'm going to, do the calculation at each step so that you guys don't get confused. Okay. So what is the total amount that I'm going to pay is $61,000. Okay. Now let's look at this. So let's move to Q3. Let's say that LIBOR drops to, let's say, 4.5 percent. So what's the total that you're going to pay? 4.6%. Okay. So again, and then you multiply that into 1 million into 4.6%. Okay. You'll get 46,000 USD. Okay. So are you guys getting this? Right? So what's happening to company ABC? Now we'll take it up to four quarters so that it's we complete out the year. Now let's say the LIBOR. So what did we do? We did 4, we did 6, 4.5, and let's say that it jumps to, let's say, 8%, right? And again, I'm using exaggerated numbers, okay? But this is to help you guys understand the thing properly. So total what will be 8.10%. So again, $1 million into 8.10% equals $81,000. Yeah, so that's what we're going to get to, right? So just give me some time. So we have to walk it through with everyone. Okay. All right. So are we clear? And do you guys understand what is happening to company ABC? Is that what are so they are at the mercy of the LIBOR rate, right? So if the LIBOR rate keeps increasing, they have to pay more. If LIBOR keeps decreasing, they have to pay less. Okay. So this is what's happening to company ABC. Okay. Now for the time being, right? Forget about company ABC. Let's just not look at them for a minute. Okay. Not for a few minutes. Now let's look at company DEF. Okay. Now they also have taken a loan of USD $1 million from HSBC or any other bank, whatever it is. Okay. Now what they are doing is they're paying a fixed rate of, let's say, 5%. They're paying a fixed rate of 5%. So what does this mean to company DEF? So in Q1, what will be their interest payment? So hang on, Vibhor. Don't look at profit or loss and all that. Hang on. We'll go through step by step, okay? Because you've been studying for your CFA and all that, right? So you would have got some exposure to this, but a lot of the others have not, right? So in Q1, what is the interest rate going to be? Fixed rate, right? Now, and I said that is 5%. So what is their interest payment going to be to let me see, what will company DEF pay to HSBC? What will it be? Oh yeah, 5%, right? Yeah, so 5%. So again, I'm just doing this thing so that everybody's clear and then there's no doubts, right? So $1 million into 5% equals $50,000. Okay, so this is happening in Q1. Now, what will happen in Q2? Okay, very good. So every quarter it's going to be the same $50,000. Q3 is going to be again $50,000, and Q4 is going to be $50,000. Okay, is this clear with everyone? Right. So I've not come to the swap part yet. Okay, I've not come to the swap part yet. But this is what is happening to company ABC and company DEF in a on a, let's say, from Q1 to Q4. Okay. Now, now let's say that you are company ABC, and I'm company DEF. Okay. What should we be worried about? What should company you as ABC be worried about, and what should I, company DEF, be worried about? Can anyone tell me? Okay. Okay. Interest rates go up in comparison to what? Okay, so you guys, some of you are getting it right, but yeah, good Shreya. All right. So company ABC is what is they are. Oh, hang on. They are bullish on LIBOR. Okay. So what does that mean? Is that they're expecting LIBOR to go above the fixed rate. They're worried that what if LIBOR goes to more than 5%, right? So they're very bullish on LIBOR. Okay, now when we talk about company DEF, right? Hang on. Now, what is company DEF worried about? Okay, they are worried that what if LIBOR comes down? Okay, they are bearish on LIBOR. Okay, now when I say bearish on LIBOR, they're worried that what if LIBOR comes below 5%? Okay, is this clear with everyone? So ABC is worried what if LIBOR is greater than 5%, and company DEF is worried about what if LIBOR goes below 5%. Okay, is it clear with everyone? Okay, so now what are they going to do? Now obviously ABC doesn't know, ABC doesn't know DEF, DEF doesn't know ABC. So what are they going to do is they're going to contact a investment bank. Yeah, so yeah, they have exposure to the interest rates. They're basically exposed to the floating rate. Okay, now what are they going to do is that they're going to contact an investment bank to do what? To get into a interest rate swap contract. So now what is going to happen here is that, let me write it below here. So both company ABC and DEF will contact an investment bank, and they want to enter into a interest rate swap contract. Okay, now what does that mean is that company ABC, and I'll show the proof for it in a bit, company ABC will move from a floating rate to a fixed rate, and company DEF will move from a fixed rate to a floating rate. Okay, so that's what I'm going to show you guys. Okay, all right. Now I want you guys to take a few minutes, write this down. So I want you guys to do all of this like on your notebook, right? And I hope you guys are writing all the notes, right? On one sheet of paper, right? I want you guys to write this down and say before interest rate swap, and you write company ABC, company DEF, and what they're paying, what is ABC paying, and what is DEF paying. Okay. Then what we'll do is after the, so what we just discussed about was before the interest rate swap. So write all of this down. Then we'll talk about what happens after the interest rate swap. Okay, is this clear with everyone? Okay, so take a few minutes and write this down and let me know when you're done. Do you guys want me to scroll down?
Sir, please scroll up. Sir, am I audible to you?
Give me 1 second. Let me know when you guys are done. One, two, three, four, five. What about the others? I'll give you. All right. I think that's the majority, right? Ganesh, Saurav, 1, 2, 3, 4, 5, 6, 7, 8. Okay. What about the others? There's 23 of you here, including me, 24. Oh, okay. 9, 10, 11. Okay, cool. Let's move on then. Okay. Now, what we just talked about was before the interest rate swap. Okay. Yeah, let me just copy this part. Okay. So, company ABC and DEF contacted an investment bank, and they want to now enter into an interest rate swap contract. So, how does that look like? Okay. So, company ABC, okay, will pay a fixed rate of, let's say, 6%. So I'm randomly making up numbers. Okay, 6% on a $1 million, one, come on, 1 second, on a $1 million notional. Okay, and company DEF, okay, will pay LIBOR plus, let's say, 20 basis points on a notional, on a $1 million notional. Okay, notional. Okay, now this is, so since this is OTC derivatives, right? Uh, so all this will be negotiated by the investment banks on behalf of ABC and DEF, and this part here, okay, this thing that I've highlighted here, right? This is the interest rate swap. This is the interest rate swap. Okay, is this clear with everyone? Okay.
Sir, why company DEF will pay LIBOR plus BPS?
We'll come to that. 1 second, Deepesh. You're going ahead. Just stay with me, and your questions will get answered. Just give me a few minutes.
Okay.
Okay. So, but guys, everybody understood, right? So ABC approaches investment bank, DF approaches investment bank. Investment bank negotiates the interest rate swap, and basically what will happen is that ABC will pay a fixed rate to DEF, and DEF will pay to ABC LIBOR. Okay, and this is the interest rate swap. Is this clear with everyone? Okay, all right. Now let's see what happens once they have entered into the swap contract. Okay, so now let's do the calculations. Okay, so what first we'll do for company ABC. Okay, now hang on. Okay, now company ABC. Okay, in Q1, what have so okay? Let me also clarify one thing, right? In an interest rate swap or any of these contracts, right? ABC will not pay HSBC, which is DEF's bank, and DEF will not pay Standard Chartered Bank. Okay, they will continue to pay the loan amount to the respective banks. Now, logically think about it. If you have taken a loan, can I pay your EMI? Can I pay it on your behalf? No, right? You still have to continue to pay that. So in Q1, what's happening for ABC? So $41,000 is paid to Standard Chartered Bank. Okay, Q1, $41,000 is paid to Standard Chartered Bank. Okay, yeah. So it's an outflow. So payment has gone out. Okay. Now, what else has happened? So what else has happened? What is company ABC then doing? So if you guys look at this, company ABC will pay a fixed rate of 6% on a $1 million notional. Okay. So how much will this be then? Yeah. So it'll be $60,000 is paid to who? Company DEF. No, no. So again, Ganesh, no, no, no. The 41,000 has been paid to Standard Chartered Bank. That's the interest payment. Okay. Now you have to look at what is happening inside the interest rate swap. Okay. So 60,000. Now look at what did we say? Company ABC will pay a fixed rate of 6% on a $1 million notional. Okay. So, and who are they paying this to? Company DEF. Okay. So 60,000 is paid to company DEF. Okay. Now, how much is company ABC receiving from DEF? So look at this. Company DEF will pay LIBOR plus 20 basis points on 1 million. So in Q1, what was the LIBOR rate? 4%? Yeah, 4%. So then 20 basis points, right? So it'll be 4.2. So it'll be 42,000 received from company DEF. Is this clear with everyone? Take a minute, look at this. This is very important. So ABC will still continue to pay Standard Chartered Bank, okay, whatever they are doing, whatever is the rate they're going to pay. But they've entered into an interest rate swap contract to hedge themselves against the rise in interest rates. So in the interest rate swap contract, they paid $60,000 to company DEF, okay, because that's part of the interest rate swap contract. And what have they received in return? DEF has paid them LIBOR plus 20 basis points on $1 million. So that's the receipt. Now, what is the net effect? What is the net effect? Let's look at in terms of cash, Saurav, so that it's easier to understand. Okay. So what is my total outgoing? 41 plus 60. Okay. How much will that be? Okay. So it'll be 101, sorry, $101,000 total, sorry, total outgoing. Okay. Now, how much have they received? 42. So can somebody deduct 101,000 minus 42? Mm. So the net effect, okay, thank you, Shreya, is $59,000. There you go. Is this clear with everyone? Guys, this is very important. Please make sure that you're clear. Yes, no? Okay. Okay, I want to recap again. Guys, please listen carefully, okay? ABC, we're looking at ABC's books, okay? Now in Q1 they paid 41,000 to Standard Chartered Bank. They still continue to pay their interest. Okay. Now once they've entered into the interest rate swap contract, they're going to pay 60,000 to DEF because that's the agreement, and they're going to receive LIBOR plus 20 basis points from DEF. So what is the total outgoing? Is 41,000 plus 60 is 101,000 is the total outgoing. What is the total that they received? 42,000. So what is the net effect on their book? 59,000. Okay, is this clear with everyone? Okay, all right. Now you guys walk me through Q2 because I'll have to keep scrolling up. Okay, so what is the total paid in Q2 to Standard Chartered Bank, if anybody could tell me? 61,000. Okay, so 61,000 is paid to Standard Chartered Bank. Okay, fine. Now, how much is paid again to DEF? No, no. Look at what is the share. Look at this. 6% on $1 million notional. Right? So 60,000 is paid to company DEF. Okay, because that's fixed. Okay. Now, how much are they going to be receiving from DEF? Yeah, 62,000. Is this clear? Ganesh, how did you get 52? 62? Okay, cool. So, guys, is this clear? Is received from company DEF. Is this, are you guys clear with this? Okay. So now, what is your total outgoing? 61 plus 60? 121,000. What is your total incoming? 62,000. Mm, ah, okay. And what's the net effect? 59,000. Are you guys sure? Okay. All right. Now let's look at Q3. Are you guys getting this? So how much is paid to Sansi? Q3? 81,000 is paid to Standard Chartered Bank. Saurav, hang on one at a time. Don't jump to conclusions yet. Okay, let's do this step by step because others might not understand it as quickly as you. Yeah. Okay, 45,000. Is that what it is? 45,000 is paid to Standard Chartered Bank. Okay. All right. Now, how much is again received from DEF? Okay, 46,000. Okay. It's okay. It's okay. Don't worry about it. Okay, it's just that I don't want to keep scrolling up and down. It's annoying. So how much is paid? Shreya, it's fine. Don't worry about it. Okay. So how much is paid to DF? 60,000 is paid to company DEF. Correct? Yes, no? Okay. Now, how much is received? Now, are you guys understanding where I'm getting these numbers from? 46 is, oh, hang on. 46 is this Q3. 60,000 is this 6% here. And what is this going to be? So LIBOR here is 4.5 plus 20. So what is it going to be?
For sure, interrupting you. ABC will pay 45,000 to SCB
So
in total.
45,000.
Yes. No, I am saying about the ABC will pay to SCB 45,000. You have written 46,000. It's including base
Oh,
point.
okay. Okay, okay. 45, huh?
And one more question: why
No,
we
no,
are not
no. It's
paying the
46.
base point?
No. Hang on, guys. Once again. See, in Q3, the interest rate is 4.5 plus 10 basis points. For Standard Chartered Bank, the total payment is 46,000, not 45. All right. Deepesh, it's fine. I'm anyway going to send the video. He can watch it then. Okay. Then 6% on 1 million is 60,000. Okay. Now, what is the interest rate here again? 4.5. Now it's 20 basis points. So how much will that be? What will be the interest calculation? Are you guys understanding it, or it's getting messy? Yeah. Okay. It's 47,000 received from company DEF. Hang on 1 second. Guys, all of you are clear of how we got 47,000. What is the LIBOR rate? 4.5 plus 20 basis points. That comes out to 47, right? So what is your net effect? So add your incoming, 46 plus 60 minus 47. So 46 plus 60 minus, so and minus 47. 47. So you will again get $59,000. Is this clear with everyone? Okay, I only see like 5, 6 people interacting with me. I hope the others are getting it. Okay, all right. Now let's look at Q4. So how much is paid to Standard Chartered Bank? Okay, 81 $81,000 is paid to Standard Chartered Bank. Okay, and then 60,000 is paid to company DF. Okay, and how much is received from DEF? 82,000. Okay, 82,000 received from company DEF. All right, so again, add all your incoming or your outgoing, sorry. So 81 plus 60 minus 82. What will you get? What's the net effect? Are you sure? 59,000. So what happened to company ABC? If I could sum it up, right, is that company ABC moved from a floating rate to a fixed rate after they entered into a interest rate swap contract, right? Now, if we scroll up, so let me scroll up, and if you notice this, right, in Q1 41, okay, Q2 61, 46, 81, so they were all over the place, right? But now what happened is that because they entered into an interest rate swap contract, right, in Q2 they ended up saving money, and in Q4 they again ended up saving money because they entered into a interest rate swap contract. Okay, is this very clear with everyone? Okay, now I want you guys to quickly write this down, okay? Because I think there's another batch that's going to use our login IDs by 5. So quickly write this down, and then we'll calculate company DEF as well. Okay, quickly write this down, and then we'll move on. Can I scroll down or people are still writing? But Biswajit, the calculations you can only do, no? It's the same. Guys, can I scroll down? Yeah, but you guys will be able to figure out the calculations, no? On your own. Okay, guys are done. Okay, I mean, you guys got the calculations, right? All right, now let's look at company DEF quickly. Okay. Um, okay. So what's happening in Q1 for company DEF? What is it? 5%, right? So 50,000 to HSBC. 50,000 paid to HSBC. Now, how much did they pay to ABC? Okay, 42,000 paid to company ABC. And how much did they receive? 60,000. 60,000 received from company ABC. So what's the net effect? Wait, there's something wrong. It can't be that, can it? Okay. Ah. Okay, net effect is 32,000. Okay, is this clear with everyone? Okay. Now in Q2, what is happening? Again, 50,000 is paid to HSBC. And how much did they receive from ABC? 62,000 paid to company ABC. 62 or 60? 62. Okay, 62 paid to ABC. And how much did they receive? 60 from company ABC. So what is the net effect? Sarnash, don't give, there's no negative here, right? So even in the first one, right? So you're doing 50 plus 42, you get 92 minus 60 is 32. So keep it as positive cash flows because then it'll get confusing. Okay. Now in Q2, what's happening? 50 plus 62 minus 60. So net effect is 52,000. Okay. That's fine, but then as long as you are clear with it, okay, because others might get confused if they see a negative sign in front of it, right? Now, what's happening in Q3? And guys, we might get disconnected at 5, okay? If we do, it's okay. I'll meet you guys tomorrow, but let's just quickly complete as much as we can, okay? So for Q3, what is it? 50,000 paid to HSBC. And how much is received from company ABC? 52,000? No, no. 47. 47 thousand paid to company ABC, and then how much is received? 60,000 received from company ABC. Okay, what's the net effect? Is 37,000. Okay, and quickly in Q4, 50,000 paid to HSBC, and how much did they receive? 82,000 they paid. $82,000 paid to company DEF, and they received 60,000 from company DEF. So what's the net effect? Okay, 72,000. Okay, is this clear with everyone? So what's happening with company DEF? Okay, they were on a fixed rate and they moved to a floating rate. Okay, so if you guys look at this, right? So whenever, if the interest rates were less than the fixed rate, right? So for example, in this case, if they did not enter into an interest rate swap contract, they would have paid 50,000 only. But now, because they entered into an interest rate swap contract, the net that they had to, the net effect was only 32,000. Okay, so they ended up saving, what is it, 18,000. Yeah, they ended up saving 18,000, and in Q2 they say they paid 2,000 more. In Q3 they saved 13,000, and Q4 they paid more. Okay, 22,000 more. So if you guys see this, right, basically we proved that DEF moved from a fixed rate to a floating rate. Okay, is this clear with everyone? Yeah, pretty easy, right? Okay, let me quickly take attendance. You guys don't log off. 1 second. Annette, Prana, Arpit, Saurav, Priyal, Vishwajit, Deepesh, Ganesh, Ira. And guys, all of you, I'm assuming, should have completed your assignments. I do not want the first half still pending. Where did I leave off, Sakshi? Cern, Ash, Shreya, Saurabh K, Shubhansi, yes, time. Okay, cool. So tomorrow we'll anyway have the rest of the uh, swaps. Okay, but what we'll do, right, we'll start on time. We'll just maybe, because today we discussed the discussion went for too long, so we ended up extending. Okay, so but from tomorrow's class, right, we'll discuss about 5 minutes and we'll finish on time by 4:30. Okay, and then we can discuss later for half an hour. So, and what I've done is for next week, right, I've requested the classes to be extended, so from next week we'll have a 3-hour class. Okay, all right, cool. I'll see you guys tomorrow. Okay, take care. Bye bye. Bye.